Hello there, folks, and welcome back once again to another episode of Southbank Live, episode 45, no less. Apologies for the slightly late start. YouTube is having some issues at the minute, so we'll probably just be streaming this on the other sites for the moment, like on Facebook and on LinkedIn, and then referring folks who are waiting on the YouTube one to go to those. Anyway, just to get us started with tonight's episode, John, welcome once again. It's great to have you back. And of course, we have so much to discuss. We have mentioned in so many other episodes how it looks like we're going to get a repeat of some of the themes from the 1970s again. And now we're getting windfall taxes on energy firms. Do you think there might be capital controls coming next?
Well, capital controls are pretty serious, but then in a way they're no more serious than economic sanctions. Capital controls are seen, however, as defensive rather than offensive in nature, and so the reasons behind their implementation tend to be quite different. But oddly enough, their effects can be very much the same. When you stop capital moving around, you do get in the way of actual goods moving around. And so capital controls can also constrain trade. And so many of the macroeconomic effects of capital controls can be compared to the macroeconomic effects of sanctions. And to
Right.
the extent that sanctions are already contributing to a wide range of inflationary pressures, supply issues, and ultimately are going to contribute to pressures towards recession. Capital controls would only exacerbate that. Now, do I think it's going to happen in the near term? Probably not. But history does suggest that if we continue down this road, where things just keep getting economically worse and worse, some countries may choose to resort to capital controls to try and protect in certain ways, because it doesn't really protect overall, but it protects certain aspects of your domestic financial system, your money, your currency, and of course gives the government a degree of control they wouldn't otherwise have, which they'll claim is for a good purpose, but history suggests it's more frequently not.
Yeah, we'll hope they won't go quite that far into the down memory lane into capital controls, but I can't say I've got much hope that we're not going to go there at some point. Good evening to everybody who has joined us live this week. Yeah, apologies, folks, for all those who are having to view it not through YouTube but through Facebook or LinkedIn. We are just having issues with YouTube once again. But hopefully all the folks who were waiting there will be able to come over to this stream. Just to start off, one headline that we could use, I think it's from the Financial Times regarding Rishi Sunak and the windfall tax on energy firms. There was there's been quite a lot of write up on this, and it's something that it does seem to be inevitable in some ways, but also one would have hoped that such an individual like Rishi Sunak, who is claims to be small state conservative, doesn't really chime that well, I would say. John, what do you make of it?
Well, it doesn't at all. I mean, this is pure politics. There is no way that anyone who even remotely claims to be, conservative, believes in less rather than more government, believes in lower rather than higher taxes, less rather than more regulation. A windfall tax is it's a very socialistic concept. The idea that you suddenly change the rules when conditions make it politically expedient to do so. That's all that's happening here, and I have to say it's disappointing. In a purely economic sense, it's disappointing, but it's also, I think, disappointing in a political sense. You want there to be at least one party in any country that stands up consistently for small government, free market principles. To not even have a party standing up for it, I think, is a shame. And so here, the party that should have been able to resist this can't. Now, I have a theory as to why they can't, which is that they've become so deeply unpopular for so many reasons. They felt they simply had to respond to this one and try to rebuild some political capital. Now, again, I think it's a bad idea, but in a purely political sense, they may simply have felt they had no choice. So off they go.
Yeah, we are. There is a question in the chat from Jason who asks, "Why is the windfall tax inevitable?" Well, I said that, Jason, just simply because there's such a large target. So there are so many people who are frustrated with their energy bills and, of course, with high energy prices that it makes them an easy target, or at least an obvious target for somebody who wants to be politically popular and to get a lot of money out of it. And of course, that's what's going on in this case, despite all of the claims that this would not happen from other politicians. Just to start off, maybe switch to a slightly milder note, John. I was thinking we could go to our long short section. I think my long short this week, simply for our 70s reboot, I think we should all be long brown suits, as they will soon become in vogue and very expensive once again. And I think we should probably be short skinny jeans, as it's flared jeans that will be coming back. What do you think? What's your long short for this week?
Well, I have to say I probably prefer yours because it's certainly more entertaining. Mine is very mundane by comparison, although it follows directly on our discussion a moment ago about the windfall tax. I mean, this is very disturbing, right? Because again, it's coming from the party that, in theory, should have been able to put the pressure for this sort of thing. And really, the problem is this: is that London and the UK generally, but of course London, benefits tremendously from its financial position. And it's not lost on energy companies or other natural resource firms. They're listed in London for a reason. They make London their home for a reason. It's seen as an attractive jurisdiction, a jurisdiction that allows them to do what they do more or less around the world to try and, basically develop the energy infrastructure, develop the natural resources infrastructure, and obviously get the stuff out of the ground and get it delivered to whoever's going to refine it, process it, turn it into consumer products, so on and so forth. So they're here for a reason. And one key reason they're here is because they did not think the government was going to do this. And because London is traditionally the home of so many energy and natural resource companies, I mean, that's a historical legacy of things, of course. Yep. That's a huge portion of the broad market capitalization. For example, relative to the US Standard & Poor's Index, I mean, the FTSE is much, much higher as a proportion in terms of the natural resources and energy and whatnot. It's a hugely important part of the stock market. And it's a hugely important part of a lot of the financial jobs that are created around that in the City of London. This is really, really not the sort of thing that makes people choose the UK as a jurisdiction in which to headquarter their business. And so I'm basically going to say you really want to see this as a reason to short the UK. I mean, it really is disappointing. What's going to happen? I mean, is any firm that ever gets lucky for some reason not going to be able to realize those profits? When you invest in infrastructure, you are, of course, hoping that that infrastructure long-term is going to be profitable. And if you're not allowed to participate in that profitability, you're less likely to invest. And if you're not able to take advantage of a UK jurisdiction to protect your property rights to the occasional windfall profit, you're not going to want to do business here. So I think that's a real negative. And I think a number of countries now might question their UK presence. And that's a negative thing for the UK. That said, the question becomes, if you're not going to be in the UK, where are you going to go? Well, wait and see, because it could be, of course, that other countries are going to have pressure to impose their own windfall taxes on domestic energy firms. And any country whose current government can stand up to that is going to be seen as a potentially more attractive place now to do business. Capital goes to where it's treated best. Capital will create new investment and jobs where it is treated best. And ultimately, of course, that creates something to tax. So the politicians who aren't stupid enough to shoot themselves in the foot with windfall taxes are going to reap the benefits of mobile capital flows around the world. And this is just one more lesson. We've been down this road so many times before. So yeah, look for where capital is being treated relatively well and consider investments there.
Right. I mean, this, of course, has been done to address the enormous cost of living crisis all this inflation has brought about. But what really worries me is when you're going for energy specifically, you're only going to make the problem worse because you're going to disincentivize further investment in energy and ensuring that the supply of energy is free and flows to everybody at good
Absolutely.
prices. This
No, this
isn't
is
going to make it
absolutely
worse.
right. This is absolutely right. I mean, so think of it this way. Let's say, for example, that hey, in a few years' time, for reasons that are exogenous or just totally whatever, oil price declines. I mean, is the government suddenly going to give subsidies to the oil companies? Right? They're probably not. And so it's very, very unfair to levy these sorts of windfall taxes if you want to encourage investment, as you say. And any industry that is discouraged from building long-term investment because they may not be able to participate in the occasional windfall profit year, it's just look, it's a fundamentally bad idea. It's been proven historically time and again to be a bad idea. And given that we're already facing the largest energy crisis in decades, to be adding fuel to the fire now is extremely bad public policy and sets the stage for real crises down the road. Who knows what it might be, right? Electricity blackouts, another sudden petrol shortage that leaves cars stranded on motorways. Now, is this really the sort of borderline, third world country that the UK wants to become? I don't think it is. So this is extremely short-sighted, and the negative long-term impact could be extremely bad.
Yeah, it wasn't that many episodes ago, John, that we were discussing Royal Dutch Shell going over to the UK to set up headquarters here. I wonder if they're feeling that that was the right move at the time. Uh, yeah, it really does worry you what that could do for energy supplies in the future. And we have plenty of comments here in the chat. Jason says a windfall tax would cost jobs, discourage foreign firms from investing in, say, the North Sea. Yeah, indeed. And as Josephine says, David Murren said the windfall tax would happen. Hope he's right about gold as well. It was funny that, so during that conversation I had with David Murren, I was getting all excited for these projections of $400 oil, as it would be great for Aberdeen. And yet here we are. And maybe despite the high oil prices, we don't end up prospering as a result after all. I mean, John, when you're thinking of other countries which may follow our lead, are there any that you can think of just straight off the bat?
Well, again, this sort of thing is popular, right? It's politically popular. It makes no economic sense, sadly, but it is politically popular. I don't know. It's the thing is, most in Europe anyway, most energy companies have a limited international presence. They tend to do domestic refining. And they tend to have maybe some small overseas assets, but it's a small portion of their overall revenues. So they do domestic refining, domestic distribution, retail. They run petrol stations and whatnot, and so those downstream businesses, they really don't benefit materially from an underlying spike in global oil prices. It's the upstream businesses that do. They tend to be more global. They tend to be listed in global centers such as London. So I don't think other European countries are really going to be able to look at this. Norway is an interesting case because they are so unbelievably energy rich. But given the fact that their energy companies and the profits on those energy companies are already taxed in a way which funds their sovereign wealth funds, I suspect that in a way in Norway, that one is settled. That is, when the oil companies make an unusually high profit, so much of the tax is going into the sovereign wealth fund anyway. The people sort of feel like they're participating, unlike in the UK, where there's no direct pass through from any of the energy revenues to any sort of sovereign wealth fund concept. It's not like that in the UK at all. So Norway, it's not really a direct comparison, but of course they're going to, their energy firms are going to benefit from this in principle. So no, in Europe, not really. In the US, possibly. I think the US is less likely to go there, but certainly there is going to be some pressure to go there. And possibly in South America, you might see some of the big energy firms there, Petrobras or Pemex, coming under some pressure to do, I don't know, to contribute more, whatever it is. What was interesting, though, and this is a related topic, was the statement that was made by, I forget which Polish politician, that Norway's participation in this energy price boom, they're benefiting from that. Actually, what they should do is they should share that with their other NATO members who are on the front line in the Ukraine conflict, who are suffering because of their big energy problems and their inability to prosper, and indeed their need to pay higher prices. That's an interesting political one to watch.
Certainly, certainly. Good evening to everybody who is joining us live. I do see a few folks who've joined on a little bit later. That's quite all right. Hello to Andrew and to Jason and Liz. And apologies, folks. YouTube is not it's not complying with us today, so we are on the outskirts of social media instead. Chris says we're all socialists now. It is an interesting sort of turn of affairs. Chris also says, I used to like the Tory ethos, but it's changed. I'm libertarian now. Well, at the minute, I wonder what is the current Conservative Party's ethos at all? Because to me, it just seems like New Labour with a bit more of a boost. I'm wondering what the appeal really is to I don't know, small government, low taxation, etc. But I guess we'll find out, and it is interesting to see how this will affect the other side and the political economy in this country more generally. Jason is short companies related to discretionary spending, i.e. Just Eat, and is long companies offering discounted or cheaper items, i.e. Walmart. Sounds like a good shout, Jason. I'd definitely be along for that one. If you do have a long short for this week, do let us know in the chat. Alice says Rishi is caving into political pressure. He doesn't have enough experience of this type of downturn to understand the consequences. It's the 70s and the 90s. A go. Yeah, I agree with that, Alice. But one would hope that Rishi had done a little bit of history on the 70s and the 90s, and maybe had a bit of a backbone. But alas, here we are. John, what do you make of the idea that the real cost of Partygate is now £7 billion? Do you think that's fair or a bit too cynical?
Well, no, that's kind of what I was alluding to earlier. That is that if this government had not already burned through so much political capital, they wouldn't feel so much pressure to do something which makes no economic sense. And so that really, I mean, especially given their supposed orientation and political ideology. So yes, I think that actually described the situation rather well.
Yeah, well, I hope there's not more parties coming down the line then. I dread to think how much those are going to cost. Billy says, aren't John's views a bit cynical in a democracy? Shouldn't we be concentrating on creating a fairer society? Well, Billy, I think we're more afraid that this is actually going to create a much unfairer society. It is the poor who are going to get really whacked with inflation. They're the ones who feel it the worst. And I think these kind of policies are actually going to make inflation much worse in the longer term when it comes to the cost of energy. So this is all a response to the higher cost of energy already. We're going to tax all these companies, which will discourage them from bringing more energy online. And we're then going to give that money to people to then spend on energy to increase the price of energy. So I think it's more the negative consequences, creating an even less fair society that myself and John are afraid of. But John, please correct me if I'm wrong.
Look, this is a somewhat complex issue, but it comes down to this. At the end of the day, the only way in which we are going to feed, clothe, and shelter ourselves, and hopefully, right, progress through time with the ability to feed, clothe, and shelter ourselves for relatively less effort, that is an improved standard of living, the only way any of that comes about is because of growth and refinement of the capital stock. The capital stock is that sum total of all the wonderful tools and machinery and technology and everything that we've got that puts food on the table, shirts on our backs and roofs over our heads. And the fact is that the only way any of that gets built in the first place, the only way it gets properly maintained, the only way that it gets expanded, the only way that it gets adapted and improved over time is with investment. Just keeping the lights on, just keeping the roof from leaking, these things require constant investment. Now, everyone would agree that except if you don't live in a pure, state of nature anarchy, there needs to be some way in which that infrastructure is nevertheless taxed at least a little bit in order to fund the basic protection and maintenance of any functioning society. Almost no one's a pure anarchist, and that certainly isn't, I'm certainly not either. Okay. So the question then becomes, I mean, how do we best encourage businesses to go about building that capital stock in a way which is fair? Well, basically, fairness, in my view, means you come up with a level playing field, which basically treats labor and capital in similar ways in after tax adjusted terms. And there are a set of economic rules that one can set up, and laws, of course, that embody those rules and contain those rules. And this allows a society to grow that capital stock with a tax base which taxes capital and labor contributions to that capital stock in a more or less equal way. But once you have that set of rules in place, what you don't suddenly do is change it just because some exogenous economic variable changes. That suddenly swings the distribution one way or the other. And it's like saying, well, gee, there's one player on the pitch who's having a rough day of it. Let's tie a ball and chain around everyone else's ankle to make the game fairer. Well, it might kind of make it kind of fairer because someone's having a bad day that day, but it's also going to make for a really crappy game that doesn't really entertain anybody. And so this is the problem you have. And so the short answer here is there is a way to do this fairer that does not require arbitrary government intervention whenever there's a sudden swing of some economic variable. The world's full of swings of economic variables all the time, usually on a small scale. But when the government gets involved to intervene in that way, it's dangerous. As Friedrich Hayek famously said, look, you need to have a really good referee in order to have a good football match. But the referee shouldn't also be playing the game.
Quite right. Yeah, I think, though I would go contrary to that, I think putting a ball and chain around all the players' legs would actually make for quite an entertaining game. But that's just me. Okay. That's just me. Okay. I mean, John, one thing that I find quite interesting about this is that Rishi Sunak has said, in doing this is quite in sort of Chavismo style. This is going after the extraordinary profits that have been made by certain energy companies, and this is just a one-off, and we won't be doing this again next year once energy prices return to normal. And you see, I don't think energy prices are going to return to normal next year, and there's still going to be this call for more government action, and then they're just going to be forced to do it again because that's what they did the year before. Am I being too cynical here, as Billy might say?
There are lots of taxes historically that were always introduced as temporary, right? Many taxes were introduced as temporary, and most of them are still with us today. That's the way these things work. Keep in mind, guys, I mean, the income tax was temporary. It was not meant to be permanent. And actually, this is the second time the UK has done it. The first time the UK ever had an income tax was during the Napoleonic Wars to help fund what obviously were very expensive military campaigns fighting Napoleon. But when the Napoleonic Wars were over, guess what? They ended the income tax. And they only then reintroduced it many decades later when they decided they needed the revenue again. So anyway, taxes, so-called temporary taxes, almost always end up remaining permanent in some form. Once governments start taxing something they really don't like, having to not tax it, because of course it reduces their ability to do what they think is their reason to exist. And so anyway, and again, I think Milton Friedman summed this view up by saying there's nothing more permanent than a temporary government program. And certainly he would include taxation in that.
Yeah, I believe inheritance tax is a similar story with raising war funds, and then the government just gets used to this nice stream of money coming in and just carries on with it. There is a few different angles we could go from here, John, of course. Well, we do indeed. There is some interesting ideas in the chat for what BP should be doing, including reneging on their deal to withdraw from Russia and then drilling over 250 miles from the UK and registering in Bermuda. I don't think that would be very popular on the PR side. I think you'd see a lot of resignations there from the marketing team. But maybe, Robin, maybe they will do that. We do also have a few folks saying they might be considering changing up some of their North Sea investments, which I think would be a great shame. But I am biased, of course, as I'm from Aberdeen. Now, moving on to a similar story from this, I think, because I think this goes hand in hand. It's almost like the other side of the coin. John, I remember, I think it was at Christmas time. I think it was our Christmas show. You were short green and ESG because you were saying we've hit the top. And interestingly, we do have some headlines that I thought we could explore a bit on this today. Now, one of these was on. There's one from the Financial Times, and there's another one that is from. There's another one that's from Forbes as well. So we've got the SEC preparing to crack down on misleading ESG investment claims because ESG has become so large, and people have started to cotton on to the idea that, well, you can always just say that whatever you're doing is ESG appropriate and very green, etc. And we have another headline from Forbes with a very interesting tale of the head of responsible investment at HSBC giving a very controversial speech at a Financial Times event where he said, who cares if Miami is 6 meters underwater in 100 years? Amsterdam has been 6 meters underwater for ages, and it's fine. Now, I think there's a couple of different angles here. I think we'll start off with SEC investigating ESG claims. What do you make of that, John? Because it does feel like the tide has shifted an awful lot from where we were in 2020, and everything was pro ESG, everything was pro green.
Oh, absolutely. I think we are beginning to see a shift. We were beginning to see a shift before. It was more subtle. And the initial shift was this. It was a lot of ESG investors beginning to realize that some of the stuff they invested in was making misleading claims. Lots of that had been coming out, little by little. And so what was happening was there were actual agencies getting their act together to become sort of ESG ratings agencies in a way that would certify whether companies really were doing what they claimed to be doing or not doing, right, with respect to the environment, climate, social issues, governance, all the ESG stuff. And so there was this concern that maybe lots of stuff was getting through that really was not as ESG as it claimed to be. So that's been going on for a few years now. What is changing, I think, is that people are starting to realize that it's still not that easy. You can't just create some ESG ratings agency either. It's so complex.
Yeah.
It is such an impossible thing to really define in a very, very robust way. There's so much subjectivity still that goes into a lot of this stuff that people are starting to throw their hands up, and they're spending more time hair splitting whether something really is as EG compliant as it claims to be. And so you're getting into this reverse 80-20 rule, right? You're spending 80% of your time really only analyzing 20% of the company. And so how can you possibly then decide whether it's a good investment or not if you're only looking at a small part, which is the part where you've got this very, very difficult ESG thing to sort out? What about the whole rest of the firm, whether they're going to be profitable or not? Whether their new product is going to succeed? Who knows what it might be? And so there's a sense of exasperation now because it's just come so far. So I think that, yes, it's been brewing for a while, but we're kind of getting into straws breaking the camel's back territory with what's going on. And so there's going to be a lot of reassessment to do now. Nobody can just hide behind ESG. No credible fund manager can just hide behind ESG and say, well, my fund's compliant. You can't do that now. Your job's really going to change.
Yeah. What do you think will come as a sort of second order effect of that?
I think two things will happen. First of all, what I mentioned a moment ago, that is that you're going to have specialty firms doing ESG certifications. I think that will continue. I think that momentum will continue. However, at the same time, I think you're going to find that because they're willing now to do that job. Your traditional fund manager is going to go back to doing his or her traditional job, which is focusing more simply on, is this a good profitable investment? And leave the ESG certification aside. And so the jobs are really going to split now to private agencies on the one hand and investment firms on the other. But what I think that will do, and this is an interesting one, those fund managers whose job it is now to focus primarily on profitable opportunities, they're going to naturally want to really focus on finding the most profitable opportunities. And so you're going to see a bit of a split now, a bit of a split in the industry. Part of the industry is going to say, oh, yes, we've got to stay ESG compliant. But there's going to be part of the industry that's simply not going to be, there's going to leave that to someone else to do. And it'll be interesting going forward then to see which managers actually do better going forward when they're concentrating on one side or the other.
Yeah. And when you're thinking of how it ties in with what we were just talking about with windfall taxes on energy firms, I mean, do you think one of the reasons why it's so politically palatable to now go after fossil fuels with windfall taxes is a product of some of the ultra pro ESG content that we've seen over the past couple of years?
Oh, it's certainly an easier sell now because of the whole ESG narrative. And the whole, I mean, all the whole climate narrative, all these things, right? It's certainly, there's a certain portion of the electorate who is still willing, and I use the word still for a reason, I'll explain that in a moment, still willing to make this trade-off between directing more resources towards green activities, and of course, those resources being acquired by taxing old industries that are seen as dirty and unclean and whatnot. So there's a certain portion of the electorate that certainly feels that way still. But how long is that going to last? That is, how high are their energy prices going to rise? How expensive is the food on their dinner table going to become? How many corners are they going to have to cut? How much less disposable income are they going to have to spend raising their children? How long are people going to allow things to go in that direction before they simply say enough is enough? Now, it's not immediately obvious what the cause of a lot of these price rises are, but
Yeah.
no one can deny that some of the upward pressure on energy prices, and in particular some of the infrastructure problems, were already surfacing, long before the war in Ukraine kicked off, and long before this most recent, more spectacular general global price spike in energy. This has been brewing for a while. So at some point, people are going to probably lose some of their enthusiasm for the ESG craze.
Yeah, though I wonder if they would lose their enthusiasm for windfall taxes just because of the higher cost of energy. John, taking a look at the other story there, where you have the head of responsible investment at HSBC giving a speech which didn't draw him much applause, at least in the video that I saw of it, and subsequently getting cancelled by people saying you're not being serious enough about things like climate change. How dare you, etc., etc., etc. Now, I would encourage everybody to take a look at this for yourself. There should be a link to that article, the Forbes article, in the description of this video, and in that there should be a link to the video of the presentation. It's from the Financial Times. It is on YouTube. And it is, I think the title was something like "Why we should care less about climate change." And he railed against people like Mark Carney and the models that central banks are now coming up with in order to scare people about how climate change might affect the world and how we need to make massive adjustments as a result. I would encourage everybody to take a look at the webinar and make up your own mind about it, rather than simply reading what the coverage is of it and how the media is trying to influence you about it. Personally, I thought he made some very interesting points, certainly on the central banking side. John, but what's your take on that? Because it does feel like it's still very politically incorrect to not be uber pro ESG.
Well, yeah, absolutely, absolutely. And look, and I say this as someone who is a keen environmentalist. I'm an environmentalist in a traditional sense. I grew up in a very very beautiful part of the world with tremendous consciousness and awareness that it was important to do everything within reason to protect the environment. And the problem is when it comes to the way ESG is defined, it's defined in a way which is again ultimately very very subjective and very very arbitrary and is therefore also prone to corruption and so it becomes a way almost to make money in of itself and of course everyone then jumps in on that bandwagon and Mark Carney for example is a great opportunist getting involved in that and trying to use his connections in the central banking world to get central banks more active into it when again, from a purely economic point of view, the idea that a central bank is an institution fit for purpose in dealing with climate changes, I think it's patently ridiculous.
Yeah.
Okay, so I have no patience for that whatsoever. What concerns me personally, and this is one of my pet peeves, I'm not going to go off on some big rant here. I'll just mention it briefly, is that there's actually a very very broad range of environmental issues and concerns, which I believe the climate, in particular, the climate concern it's actually a big distraction from what I think is a bigger problem, which is a more local concern, and it's basically it has to do with toxicity. There are certain industrial processes which are very very widespread that create all kinds of toxic residue, and they can cause problems with local groundwater. They can cause problems with local soil and food quality, and those problems then creep up the food chain into livestock and all kinds of things. And this is stuff that really really poisons people, really really ruins their lives and their communities, and it has nothing to do with the climate. And yet it's known. See, the thing is that stuff that really ruins people's lives and communities at the ground level,
Yeah.
at the local level, the science there is bulletproof. We know that lead poisons you, right? You don't have to like prove this with a climate model.
No.
Whereas the climate stuff is still very very theoretical, very very long term. And I'm concerned that a lot of resources that could be used to help clean up a lot of the known toxicity in some very poor, struggling parts of the world is being redirected to grandiose climate projects directed from, who knows where, London, New York, Davos. And that to me is just it's really a shame. It's showing the real lack of priorities, in my opinion, in dealing with known and proven environmental concerns. So I that's kind of my issue with a lot of ESG is based on such big picture, long term, poorly understood issues, and yet there's this stuff that's absolutely known that is not being dealt with. And I'll finish with this: cobalt, lithium, some of these metals that are essential for modern batteries. Gosh, getting them out of the ground and producing them into batteries and then recycling those batteries are some of the most toxic activities, industrial activities that take place today. And I'm concerned that they are actually as much or more part of the environmental problem as they are the solution, because they kind of slip through the ESG net somehow. And
Yeah.
that bothers me.
Yeah, I wholeheartedly agree with you on that one, John. That's I feel very similar. The way environmentalism and the doing something about climate change have just become lumped together as though they're entirely one thing, when in reality there's so much more nuance there. When it comes to people polluting the oceans, I think everyone can appreciate that pouring hundreds of thousands of tons of plastic trash into the ocean is not a very good thing, but it's completely different from saying we need electric vehicles because otherwise the environment's going to heat up. It's a completely different issue, and yet everything just gets lumped together, and people seem to want to focus much more on the transition to hydrogen rather than actually cleaning the world as it already is. And there's so many other different examples of that. But
There are loads. I mean, remember a couple decades ago, the emphasis was on the three R's: reduce, reuse, recycle.
Oh yeah, yeah.
Now, if that's not common sense, I don't know what is. And that to me is everything. But the problem is that companies find it difficult to get profits up and to get subsidies in their coffers from reduce, reuse, recycle. Whereas, oh my God, if you claim to have some magic technology which is going to solve big picture, long term ESG problems, you can hoover up huge subsidies and make huge profits, and you don't have to do any of the three R's, which are inconvenient and unprofitable for most firms who always want you to consume more of their product and not worry about reducing your use of it, not worrying about recycling it necessarily if you're not too bothered. So I think we've just gone astray, in my opinion, from what actually was a very sensible way to approach a lot of these issues.
Yeah. When you're thinking of the green transition and the reliance on some of these, rare earth metals and on plenty of other critical materials that are often, small deposits in exotic parts of the world, and people don't really think about that quite so much. North Korea and China, their dominance when it comes to rare earths is through a lack of regard for the environment. I mean, that's why they've become so dominant in it, and it causes all manner of horrific, things like birth defects and early life expectancy in the towns surrounding these areas because they're treating the soil in such a bad way, and it gets into the water supply. And then if you go into sub-Saharan Africa, people have seen the movie Dark Waters these days. I think that was the last movie I saw at the cinema before the lockdowns, and everyone thinks, oh well, thank goodness for that. We've got good lawyers out there fighting the good fight against these big American chemical companies that are polluting American waters. But that's in America, right? If you go to the third world, this kind of phenomenon is much more prevalent, and it doesn't feel like any of the Davos crowd really care that much about it. They're much more focused on no, we need to extract more of these rare products so that we can then make more electric vehicles and drive them around instead of Humvees and whatnot. I mean,
There's
do you think that?
there's big profits in it, right? The big
Right.
profits, and again, in principle I have nothing against profit, but to try and take the moral high ground by claiming you're doing something about this long term and not well understood climate problem, and not to deal with the absolutely known horrors that are happening on the ground, I just think it's reprehensible in my opinion.
Yeah, certainly. Certainly. And we do get some interesting comments in the chat. Andy says, Boaz, give us the website info, man. All right. I think this is a reference to that Forbes article I mentioned earlier. I'd forgotten that we're not streaming this on YouTube, so the description might be different on Facebook and on LinkedIn. Yeah, Andy, and to everybody watching, if you are interested in finding that article, you can give it a Google. But on the email that you got alerting you to us having this show, you will get a link to our YouTube there, and in the description for that YouTube stream, which hasn't gone live this evening, you should be able to find that there. Jason Schultz says, I agree, John. Just look at Kabwe lead poisoning. Fresh evidence filed against mining company on behalf of over 100,000 victims. And Jason, again, they claim ESG, but what about gold? Gold mining is one of the most destructive industries in the world. It can displace communities, contaminate drinking water, hurt workers, and destroy pristine environments. Pollute water and land with mercury and cyanide, endangering the health of people and ecosystems. Now, this is a very good topic. I think the case for green gold mining and much more efficient and less destructive gold mining is out there. It all depends on where you are in the world and what their rules are. It doesn't always need to involve the use of mercury and cyanide. I believe it's the leaching process, which is very, very common in places like South Africa. There are much more respectable ways of doing that. John, you're much more up to speed with this than me. My general view is that all of the majors have already come up with plans on making sure that they won't be the target of these kind of attacks in the future. But feel free to correct me on that.
Yeah, there have been efforts made, certainly within the gold mining industry, to try and become more environmentally sensitive, and sadly, a lot of those attitudes are prominent in certain countries, but not as prominent in others. And sadly, this is kind of a sad fact of many parts of the world that they're just not bothered about getting resources out of the ground in a way that protects the local environment. And that's single gold out for that. And in fact, gold is a much smaller extraction industry than many. I mean, the big ones that tend to be obviously the bigger the bigger energy and metals and mining industries. Gold's tiny by comparison. I mean, look at the amount of actual jobs. Look at the actual amount of capital employed in gold mining relative to iron ore, relative to crude oil, relative to copper, relative to cobalt, and so on and so forth. And so, or aluminium. My God, I mean, aluminium. I mean, is actually it's a huge industry, but if not done properly, wow, does that leave a mess? So anyway, you can't really single out the gold industry. And another way to look at it also is that the only real benefit of getting gold out of the ground, of course, is to sell it on as jewelry, or to turn it into bullion. And the value of jewelry and the value of bullion, it naturally is something that is going to naturally rise and fall vis-a-vis the price level generally, vis-a-vis the money supply generally. So in a way, the demand for gold is self-regulating, and I believe that that demand for gold being self-regulating is something that will naturally cap gold mining activity. That you're never going to see some sudden huge explosion of gold mining activity, because the fact is that it's too difficult to do over very long periods of time. It would take to invest. There's just not much of it out there, and as long as you don't have this perception that gold is clearly overvalued versus other things, because obviously if miners think gold's clearly overvalued versus other things, they're going to be generating huge margins. Otherwise, you're not going to have some huge expansion of the existing gold mining industry. So I think it's just so small by comparison, and I don't see a scenario under which it gets larger in relative terms.
Yeah, certainly. And when it comes to things like gold, it's not so highly in demand as things like energy in this kind of environment. So it's not like when there is such a demand for energy at the minute, the desire, I think, to place environmental restrictions on its extraction will be less than it would be for something like gold. And as I say, because gold is a different industry as something like oil, they're all the big gold miners and gold producers. They all hang around together. They've got their various lobby groups between them. They have already said in numerous different ways that ensuring that we have ESG protection to some degree, and we're getting around it. We're getting around the problems with environmental pollution. This is before even the pandemic. They were already sort of preparing for this. So I think this is something that won't be. I don't think it's going to be so much of an issue for gold miners, more when it comes to the big blue chip ones, but maybe more for the wildcatters out there. John, I mean, what's your take on that? Do you think the manner in which this will be interpreted will once again be? It really depends on what jurisdiction they're operating in. So, for example, a Canadian gold mine, they're going to have a lot more higher environmental protection regulations over there than something in some of the less developed parts of the world. So if you wanted to protect yourself, you'd stick with more of the developed world gold miners?
Yeah, I think that's true. Again, unfortunately, that's just sort of the way the world works. There are some jurisdictions which are going to definitely be stricter. And also keep in mind, if you're a very, very large gold producer and a mature one, of course you're concerned about your public image much more than some wildcatter that no one's ever heard of, who's only ever poked a couple holes in the ground hoping to get lucky in some jurisdictions that don't really care. But keep in mind, the latter operate on a very small scale. The amount of environmental damage they could do, even if they weren't careful, is very, very limited. So it is encouraging that your bigger miners are making this effort to try and at least make some effort together as a group to try to get each other to behave according to at least some common standard. But yes, there'll still be variations jurisdiction by jurisdiction for sure, but the really bad stuff will remain at a small scale.
Yeah, and again, as gold has such a high consumer element to it rather than an industrial one, I think the opportunities for more of a consumer-led decision when it comes to upholding environmental protection is very much out there. There was a gold miner in 2019 who produced bullion bars where I think 10% of it went to saving the rhinos and had a nice rhino on it. I mean, there's already demand for this, and as the millennials get a little wealthier, and they become big drivers of demand for gold, I can imagine there being a lot more of this, a lot more of an opportunity out there for a gold miner to say, all of the gold that we are producing is green in XYZ terms, and as a result, it has a higher price. So you see that already. There's a Scottish gold miner called Scott Gold Resources, ironically an Australian company, but they have a mine in Canonish near Edinburgh, and their method for extracting the gold, because Scottish environmental regulations are so high, they use this like gravity extraction thing where it's effectively just it's not doré, but it's the ores effectively just getting shaken around for ages, and that's it. Sort of rattles some of the gold out. And as a result, when they do go and sell this gold, the fact that it's from Scotland and it's green in this way allows it to be sold at a ridiculously high premium, and they make a fair bit of money from that. And I can imagine that happening on a much broader scale when it comes to that. But John, speaking of gold, and we are speaking of the 1970s. It seems like a golden decade, but maybe not in some of the ways that everybody would hope a golden decade would be.
Oh, well, very, very much so. I mean, look, gold does well when everything else does poorly. Okay. I mean, that's kind of the lesson of history here. It's an insurance policy. It's insurance against bad policy. It's insurance against disaster. It's insurance against, choose your calamity. And the 70s, they really unlocked a lot of potential for gold, in part because in the 60s, there had been active suppression of the price of gold under the Bretton Woods system. And so there was a lot of room for gold to rise right from the get-go when that suppression regime was ended in stages between 1971 and 1973. And so, and then the policy choices that were made throughout the 1970s to accommodate the inflationary pressures that had built up, gold soared. In certain respects, the world looks very similar today. In some respects, it actually looks worse, in my opinion, regarding the macroeconomic environment in which we're operating now. So gold should have a lot of potential. And when I look at gold, and I see how the price has yet to really respond meaningfully to this very material surge in realized inflation that we're seeing, I think there's a lot of stored up potential there. I think there are a handful of reasons why it has yet to be realized. It's going to take more time. Look, the 1970s was a full decade. Gold did not go up every year, far from it. No. So, there were times, of course, when gold did very well in the 70s. Other times it did less well, but the general trend, the longer term trend, was clearly up. I think we're in that sort of environment now. And when gold does start to move, it could move a lot very quickly because it has yet to really respond the way I would have expected it to respond.
Yeah, I feel like some of the bad price action we've seen in gold over the past 2 years, just during the pandemic period, where we did see a great rise in 2020, and then 2021, it was quite brutal at times. I feel that was just like some of the early years of 1970s, where in I think is it 72 and 73? I mean, you had gold actually down on the year, despite the fact that inflation was really starting to boom all over the place, and people weren't, they weren't appreciating that this was a trend that was going to be in place for the rest of the decade. And of course, anyone who was buying gold during that period sat pretty. But of course, in the States, you can actually own gold bullion for quite a while at that period. But of course, here in the UK, it was doable. I mean, going forward, John, Robert in the chat asked, I want to see the AU price, the autumn price in 2032. Is there any circumstance by which we may lose money in the medium to long term for gold? Now, of course, we can't give financial advice in this show. This is just for informational and entertainment purposes only. But we will be doing at Southbank a big gold summit in the near future. If you're watching on Facebook, there should be a link that you can click on in the description, where our colleagues Nickolai Hubble and Eoin Treacy will be taking a look at what's in line for gold, and John will be making an appearance too. So if you are interested there, there's certainly much more on the gold side that we have to discuss. But John, looking at 2032, nice 10-year horizon for gold, what would you think when it comes to can you imagine a scenario where the gold price is the same or lower today in 2032 than it is right now?
I really can't, because I just see no initiative on either the fiscal or monetary policy front in any major country to try and move away from the tendency towards inflationism as their underlying economic model. That is, to continue running deficits, to continue printing sufficient money to monetize those deficits such that they do not result in an outright contraction of the housing market, bank balance sheets, and all the big nominal asset prices that keep the economy stable and prevent bankruptcy from being a daily event for major institutions. So that's just the world we live in. And so I believe gold necessarily trends higher in price in that world. Now, one thing to consider, though, and 2008 is an extremely instructive year in this regard, there are times when gold could, for multi-month periods of time, come under significant downward pressure. And that's when you get a liquidity crisis. And that's when there is a flight into basically official collateral for the banking system in the form of government bonds. That is, when you get a sudden liquidity squeeze and there's not enough collateral around and there's a scramble for that collateral in the system, again, collateral being government bonds, basically, so-called risk-free securities.
Yeah.
That's when basically, no matter what you think about the outlook for gold longer term, if you have gold and you're holding it against a credit line and a bank calls in your credit line because they no longer have sufficient capital to hold against that credit line, they're going to give you a margin call, and you simply have to sell your gold so the bank can reduce that credit line and on the other side have proportionally more collateral vis-a-vis their regulatory requirements and whatnot. And when you're in that sort of environment, gold goes down. But the moment the central bank acts to relieve that collateral squeeze or liquidity squeeze, in this sense, you can use them pretty much interchangeably. The moment they act, gold is able to start rising again. Now, you could say everything is able to start rising again once they act again. But that's a scary, frightening, risk-averse environment. Gold is the first horse out of the gate in that sort of environment, when that fresh liquidity becomes available, when the collateral squeeze eases. We saw precisely this happen in 2008. Gold was the first horse out of the gate, and in fact, it had essentially a 3-month head start out of the gate, having completely recovered its previous losses before the stock markets even stabilized. So I think gold may do a similar thing again if we get into that sort of environment. So yes, there's potential shorter term downside, but medium to long term, gold is the horse you want to be riding in this sort of environment.
Yeah, I certainly agree with that. And I would add a little word for silver as well, being more on the silver side. We have been carrying on for a little while here. Again, apologies for the later start, folks, and apologies to some folks who are waiting on YouTube and couldn't get over to the Facebook side just as we began. One last thing, one last question, or one last quote on from Chris. Says we need to get off the PhD standard and back onto the gold standard. I would certainly agree with that, but makes a reference to Alan Greenspan's quote in 1998 that central banks stand ready to lease gold in increasing quantities should the price rise. Chris says they are still doing it. Any thoughts on that, John, when it comes to central bank leasing of gold in order to keep the price down?
Look, I mean, there's been speculation for years that not only are central banks opportunistically leasing gold now and again when the price rises, but that in fact that there is actually a plan to do so, that there is some sort of secret coordination between central banks to work together to prevent the price from rising too much. Look, you can't prove that's not going on. If they're doing it in secret, they're doing it in secret. You can't prove it's not going on. But you don't need to know it's going on to understand that fundamentally, if they were truly feeding gold into the market systematically to keep the price down, then eventually they'd be running out of inventory, right? Eventually they just wouldn't have enough inventory to do it. And that's in a way what happened in the 1960s, and it's what broke the London gold pool. Is that the London gold pool was requiring ever more inventory to keep the price down, and multiple players. The first big player to break was France, but then one by one, the other big players broke from that game also, and the U.S. eventually gives it up. Also, finally with President Nixon and the Nixon shock and all that. So if anything similar were happening today, not as part of official Bretton Woods policy, but as part of some secret thing, you'd still face the ultimate supply constraint. You would still run out of ammunition at some point. It couldn't go on forever because gold reserves held by central banks are finite. So that has an end game. If they are doing it, all it means is that the potential rise in the gold price as they slowly run out of ammunition is all the greater.
Yeah, certainly. The only way that they could win in the end would be if humans stopped appreciating gold, which feels,
Not going to happen.
What's going to run out first? The amount of
gonna
gold
happen.
in central bank reserves or humanity's desire for gold? I think I'm going to go for the latter there. Though, yeah, who knows? Who knows? Anything could happen. But given that human beings have been murdering each other for gold for centuries and millennia past, I don't think we're going to stop desiring it for some reason. But I think we shall hold it there, folks. One last note, which I thought I should include here. We were discussing, of course, the windfall taxes at the beginning of the show, and the energy grants that are going to be funding it. And I was saying that all this money that will disincentivize energy producers from bringing more energy to market will then be spent on energy by consumers, and that's going to make the problem even worse. Robert would like to correct me. No, Boaz, the energy grants will be spent on crates of stinking monk and musty dog. I know my people. Well, Robert, I really do hope you're right. The breweries certainly deserve the money. I think we finally got a wealth redistribution policy from the government that I can support. So we'll end it on a positive note there, folks. Thank you all for tuning in. Apologies again for the issues with YouTube this evening. We'll hope to get them fixed and manage to get back next week. We shall be doing an earlier show next week. So it's going to be at Wednesday, and it's going to be during the day. It'll be a platinum edition. I'll be doing it with our colleague Nickolai Hubble, as of course it will be the Queen's Platinum Jubilee celebrations around that time. A good time to discuss platinum, which also had a good time in the 1970s, if I recall correctly, though I wasn't there at the time. But that's all for this evening, folks. John, thank you so much for joining me.
My pleasure, Buzz.
We'll see you in the next one, folks. Sorry again for all the issues. Bye.